Hi, it's a couple minutes past 10 a.m. So let's get this thing kicked off and started. Welcome to our presentation for Coastline Capital Fund 6. I'm pretty excited about sharing this information with you and having the opportunity to show it to you. My name is Andy Mirza with Coastline Capital Fund Management. My partner Sean Irwin is on this call as well. Let's go over the webinar agenda real quick. So this will be short and to the point. It's going to be an overview of Fund 6, 25 minutes long at the maximum. If you have any questions, send your questions by email or use the Q&A button on the Zoom toolbar. My partner Sean Irwin is going to spearhead the Q&A portion of it. So by the end of the presentation, you should know whether you want to take the next steps to join us or not. The webinar is being recorded, so you can refer back to it later if you missed something. Here's our standard disclosure. It's long, so we'll summarize. We cannot guarantee any of the results of our funds. Projections represent our best estimates. Past performance is no guarantee of future results. There are risks associated with investing in one of our funds, and you may lose some or all of your investment. Finally, this offering and solicitation is for accredited investors only. This webinar is not intended for non-accredited investors. So that's my partner Sean Irwin on the left and myself, Andy Mirza, on the right. Here's an overview of what we do. We create and manage funds that invest in defaulted mortgages. These are first position non-performing notes backed by residential real estate. The loans I'm talking about are mostly toxic home loans left over from the financial crisis of 2008, although we still come across some that have been originated after 2008. We buy the non-performing notes low, and then we liquidate high through different liquidation outcomes. We prefer the severely delinquent loans because they have the highest returns. Think of us as fix and flip guys for notes. We find the loans that are severely delinquent and have something wrong with them. We add value by solving problems and exit by foreclosing, selling REOs, or reselling improved loans. Since 2015, Sean and we've purchased $9 million worth of notes. We've liquidated $5 million since, which resulted in $819,000 in net proceeds. The average weighted return on investment per note was 22.7%. The average annualized ROI per loan was 37.3%. Again, past performance is no guarantee of future results. For accredited investors who are dissatisfied with the current investment options out there, Fund 6 is a perfectly positioned distressed asset fund that provides the investor greater profit potential. Unlike the bigger note funds out there, Fund 6 offers the investor a preferred return and a profit split. It's run by a small, nimble team of experienced professionals. So let's talk about the current state of the market. Most foreclosures and eviction processes have resumed in the states that we buy notes in. In some states, operations are slower than normal, as some people continue to work from home and a lot of court proceedings have migrated over to Zoom. Exceptions are Illinois and New Jersey. Things are still stopped up there. Our experience has been a slow and steady return to normal. We closed Fund 5 at the end of July and proceeded to buy notes. We bought several notes with existing trading partners and business was normal. They weren't willing to sell at fire sale prices and didn't have any sense of urgency. We did very well with these purchases and got them at great prices through our normal process of finding undervalued assets. As for REOs, some real estate markets have been very hot, notably Memphis, Tennessee, Houston, Texas, Las Vegas, Nevada, and this is due to extremely low inventory because of the effects of the pandemic. Other markets haven't been so hot like parts of Illinois, but these hot and stable real estate markets have been great for our REOs. However, we are sensing increasing distress among some of our borrowers and their abilities to make their payments. We think the trend will be towards increasing defaults as the economic distress related to the pandemic continues to drag on. Borrowers that were barely hanging on before the pandemic will have a harder time holding on. Government support seems to be working for now, but it feels temporary. Government can only do so much. Forbearances are going to expire. Borrowers will have to start repaying on their loans soon, and not all of them will be able to do it. As far as the future state of our market, based on our experience and what we're seeing, we think that the economy will take more time to recover. These lockdowns from COVID are unprecedented, and their effects on the economy are unprecedented. And we're really in unknown territory. All the economists, people in government are doing their best estimates of what's going to happen. And both of us think that it's going to take a little bit longer to recover, and we're going to see a weaker economy in the next few years. This will cause, in our opinion, loan defaults to increase. It's also going to cause real estate markets to cool off as this weaker economy results in less demand and more supply. This government support has been helping, but once it lays off, we're going to feel the real effects that all the shutdowns have done to the economy. Will this be the new normal? Well, we don't know yet. And pretty much nobody else does. We're all doing the best that we can. The opportunities that this will provide for us. Well, more loan defaults will equal more non-performing notes. So we believe that we'll have a lot more NPNs for sale and available to us. It's also going to allow us more of an ability to work with borrowers to resolve their situations. Most of the loans that we buy are severely delinquent ones from originated before 2008. And a lot of those borrowers have been barely hanging on for over a decade. This time it's going to be a little bit different. We're going to have a lot more borrowers that got loans that they could afford but couldn't because of the coronavirus. So we'll have a lot more people that will be willing to work with us, and we'll be able to solve their situations a lot better than the banks can. We are very well positioned to participate in the market, whatever the ultimate outcome is, whether it's more of a mild recovery or whether it's a major problem down the road. The two biggest factors to our success are access and speed of execution. Since 2009, we've spent time and resources to develop relationships with loan traders. Through this, we get preferred access to institutional non-performing notes. Banks and hedge funds buy and sell loans all the time like any other asset. When they buy big pools, they keep the loans they want and sell off the rest. The people that buy from them do the same thing. Finally, the loans end up with the investors that will keep or foreclose on them. Basically, the better your access and the higher up the chain you can buy, the better deals you can get. We also have the option to pick individual loans instead of going all or nothing on pools of notes. My partner, Sean, started in this industry in 2007, and he did the hard work to develop those high-level relationships. He developed them by calling brokers and loan traders on Wall Street every day and making trips out to New York every few weeks. After months of trying and knocking on doors to hedge funds, he finally got his first loan to trade from a big bank. Sean found a buyer right away and closed that deal in a month. The bank gave him 5 more loans to sell, which he did in another month. That got him in the business, and his track record of completing deals in a professional manner solidified his relationships. That's what gets us great deals and access to product that most investors will never see. We're small and nimble. We respond quickly. We make decisions promptly without unnecessary delays after careful consideration of what's best for the fund. Big banks and large hedge funds are slow and don't seem to be in any hurry to get things done. They're great when things go well, like having tens of thousands of performing loans, but they're terrible at dealing with borrowers when the notes go non-performing. They can't seem to get things right when dealing with the hundreds of steps required for a successful foreclosure. This Chicago loan is a perfect example of this. We were looking at buying a loan and saw that the foreclosure was delayed for a year because the assignment was incorrectly prepared. By the time the bank fixed the problem and sent the right assignment to the right attorney, 1 year had passed. We ended up buying that loan, and it took us 2 weeks to do the same thing that took the bank 12 months. Things are a lot different for us since we are the owners and caretakers for our investors. No one cares for an asset like an owner does. There's a sense of urgency in how we conduct our business. We don't tolerate unnecessary delays from any of our vendors. When we buy loans, there are usually issues that have stalled our progress toward resolutions. We find those issues, fix them, and get them back on track for whatever liquidation outcome is needed. Our highest value is our ability to scour tapes of loans for sale, identify the ones that have the biggest profit potential, and to negotiate the best prices. We have our own financial model to aid us in bidding, but when it comes down to it, the final selection is based on our combined knowledge and experience of our market, our sellers, and the current trends that affect our borrowers. We're always trying to get an informational advantage when making offers. If our research determines that the value of a property is significantly higher than what the bank thinks it is, we have an advantage. To use the Chicago loan as an example, the bank valued the property at $99,000. We value the property more accurately at $140,000. The seller accepted our bid at $59,000 because, according to them, the loan to value was 60%, which was acceptable by their standards. By our standards, however, we're actually buying that loan at 42% of value. A much, much better deal. And this really is some of our secret sauce. This is how we get our best deals, is by just getting a better idea of value than what our seller does. Coastline Capital Fund 6 is a single-purpose, non-leveraged, closed-ended fund. There's a 3-year maximum time commitment, but this could be shorter based on our liquidations. If we liquidate it sooner, we'll close it sooner. There's an 8% preferred return, which starts to accrue on an investor's money while it's in the fund once we reach the minimum fund offering of $1 million. Plus, you get a 60 or a 50% share of the profit split above that. At this time, we're offering 1 million shares or units of Class A, which offers a 60-40 split, and 1.5 million of Class B, which offers a 50-50 split. The minimum investment is $25,000. However, if you're a previous Coastline Capital Fund investor, the minimum investment is $5,000. It's available to accredited investors only. We've projected that the combination of the preferred return and profit split will equate to a 15% return for Class A units and 13.5% for Class B units. The minimum fund offering is $1 million, and our target raise is $2.5 million. The fund is scheduled to close to investment on February 28, 2021, but this could also be sooner, depending on how much capital that we raise. We will, once we close the fund to investment, we'll proceed to buy 1 or more pools of non-performing notes. And this will take us about 1 to 3 months. After that, we'll proceed with note liquidations, which will take the remaining 36 months. Based on our experience, most note liquidations take 6 to 18 months. Once we start liquidating, we will not buy more notes. The net proceeds of note liquidations beyond what we need to keep in reserve will be distributed in the following order. First and foremost, to pay 100% of investors' initial contribution back. Once all investors get their initial contribution back, the next tranche will be to pay the 8% preferred return that accrued on investors' contribution while it was in the fund. And finally, it's whatever proceeds we have over that will go to pay the profit split. And that'll be 60% to those holding Class A units and 40% to the sponsors. If you have Class B units, it's 50-50. Keep in mind that distributions are only upon liquidations, meaning that the payments are going to be irregular timing and of different amounts. It's not a set schedule. There are no monthly or quarterly distributions. We do that specifically because we don't want to be in the position where we have to fire sale assets to make distribution payments. We want to maximize the profit that each of our notes can make. The fees. So fund management will charge the Fund 6 a 2% management fee. This will be based on the unpaid principal balance for the notes and market value for the REOs. It'll be paid monthly once we acquire the assets. Other than that, there are no other fees, no acquisition fees, no capital raise fees. We wanted to make sure that we have correctly aligned incentives. So the bulk of our compensation comes at the very end after we've done all the work, and that comes with a profit split. Something different about this fund, though, because of the coronavirus pandemic and the lockdowns, we've added a provision to our operating agreement that will allow us to temporarily suspend the preferred return and the management fees for events outside of our control. If we can't liquidate because the government is telling us we can't, then we feel it's equitable to investors and to us to suspend the preferred return and management fees just for those assets and just as long as the shutdown is imposed. So Fund 6 opened this morning for investment at 8 a.m. Pacific time. For 2 weeks, we are offering unlimited subscription to Class A units. So that's another thing that's different from previous funds. The million was the start point, but for this 2 weeks and this 2 weeks only, we're going to do unlimited oversubscription. If you sign a subscription agreement to Fund 6 before December 15th, 2020 at 8 a.m., you'll be assigned the Class A units. So the 2 week period only applies to getting that subscription agreement in. We understand it takes a little bit of time after that to prove accredited investor status and to fund it, and that's fine. That can happen after December 15th. After the 2 week period, there may be Class A units available if we haven't reached 1 million. However, if we exceed 1 million in the first 2 weeks, only Class B units with a 50-50 profit split will be available. Now, I've had a couple of questions from previous Coastline Fund investors, the ones that want to maximize their investments. So for Fund 4, we just had a closing for one of our REOs, so we'll be making a distribution for that this week. For Fund 3, we're expecting a couple, one at the end of the month, one in January, and then it's possible that Fund 5 will have a distribution in January as well. So if you want to maximize your investment and roll over some of your distributions, the best solution is to sign 2 subscription agreements. One is for the amount that you know that you can do, like you have the funds and you're able to do it now. And then we'll do a second one for the amount that you might be able to do. So if you're in this category and you want to maximize your investments, just get a hold of me, either call me or email me, and I'll let you know when our intended distributions are going to be and how we can structure that. As we near the end of this presentation, I wanted to share a story of one of our earlier note investments. During our due diligence, I was able to piece together the background of a non-performing note backed by a nice house in Southern California. A grown-up son deeded his free and clear property to his mother in 2007. She refinanced a few months later. After the refinance, $145,000 in judgments and tax liens in their son's name popped up on the property. This wasn't a gift. It was a plan to get out of paying people he owed money to. The house happened to be along the way to our old office in Chino Hills, so I stopped by to take a look. This slide shows the house. There was a restored Chevy in the driveway, older, clean RV. There was also a speedboat in the front yard that's not in this picture. I thought you have enough money for these toys, but not for making your mortgage payment or your other debts. I felt sorry for the mom, but she didn't have to support her son's lifestyle or poor choices. We got a great deal on the loan, so we went ahead with it. By the time the loan transferred servicing to us, the loan was about 12 months delinquent. The borrower asked for a loan mod, but never turned in the paperwork. 60-day delay for us. Right before we started the foreclosure, she finally sent a single loan payment. It would have been another 2-month delay if we would have accepted it. Finally, the day before the foreclosure sale, she filed Chapter 13 bankruptcy. That stalled the foreclosure as we headed to bankruptcy court. I no longer felt sorry for the mom when I found out that she owned her own home and a vacation home in addition to this one. She sent in a loan modification package which showed that she made $10,000 per year. On $10,000 a year, how could she afford our loan on that income, much less the other two? Why wasn't she selling the vacation home to help pay her other debts? The bankruptcy judge believed her different stories and gave her chance after chance after chance, to our frustration. She made 2 payments and then stopped. After 8 months, the judge finally saw through the excuses and granted us relief. Finally, we could foreclose. The day before the sale, we received notice that the mom had deeded the property back to her son, and now he was filing for bankruptcy. We had to delay the sale again and go back to bankruptcy court. The case went before the same judge, who was not amused at this time. She granted relief right away, but gave the son 14 days before we could foreclose. Strangers who we hadn't heard anything from before started calling us on behalf of the son to work something out. At this point, we didn't believe anything that the son or his mom or the buddies told us. The weekend before the sale, we got served with a civil lawsuit alleging that we, our note servicer, and our trustee were doing an illegal foreclosure. His attorney requested an emergency hearing the day before our third attempt at a foreclosure sale. Not every borrower acts this way, thank God. For most of our loans, we don't have to put in this much effort. But when we have to, we stay on top of things, we solve the daily problems that come up, and we don't give up. Fund 6 is the only fund out there that I know of that offers a profit split with the investors. The other note funds out there offer a preferred return, and that's it. Our investors participate in the upside with us. We truly look at our investors as partners with us. For the next 2 weeks, we're allowing unlimited subscriptions to the higher tier profit split units. After that, the opportunity will be gone. If you're interested and ready, don't miss out on the opportunity to get your subscription agreement in before December 15th to receive Class A units. Luckily, the judge in the civil suit denied the motion to stop the foreclosure sale. Finally, we were really at the end. No faking around at this time. The foreclosure sale took place the next day with the property selling at auction to an investor. The son dropped the lawsuit 2 weeks later, and we never heard from him again. Things that we learned. It ain't over till it's over. Don't be afraid of civil and bankruptcy courts. They're part of the business, and you need to learn how to navigate these. Smaller, attentive investors are far more capable of handling complicated situations than the big banks. Buying at the right price enables you to weather these occasional storms. And spreading your capital among many notes mitigates the risk even more. Today, our funds are not leveraged. We spread our risk by buying lots of notes in different areas, mostly in the $70,000 to $250,000 range. Sean and I have a very cool process for making decisions. We look at things separately before discussing our thoughts. Sometimes we'll fight and argue over what to do, but we know that each of us is trying to do what's best for the fund. We listen to each other's opinions. Two heads are better than one. It's easy to overlook something by yourself, but not so easy when you have a partner that's going to challenge your thinking. It's another thing that gives us confidence that we're making the best decisions possible. When it comes down to it, when you invest with Coastline Capital, you're getting Sean and me. You're getting our knowledge, attitude, connections, and grit. If you're ready to invest with us now, simply head over to our investor portal at investors.coastlinecapitalfm.com. You'll need to create a login profile. Then you can review our marketing materials and documents, and then subscribe to the offering online. If you want to do more due diligence before taking this step, start by exploring the resources on our website. I write a blog about the notes that we buy in detail. I write articles about our business. Reading this will give you an even better insight into our mindset and how we do business. You can also contact us by email or schedule a call with me. Thanks for joining us on this webinar. That concludes our presentation. So this is the main presentation. Now we're going to turn it over to Q&A. And I'm going to go ahead and introduce Sean Irwin, my partner. He's going to be running this part.
Hey guys, how are you today? Hope everything's good and you had a good holiday. Andy, there's one question that I'd like you to address if you can, and we can get that one out of the way, and then I'll go ahead and take over. So let me, if you want to pull up that under answered question. Larry asked, what is the best and worst performance of our previous funds?
So far, we only have one fund that's completely liquidated, and that was Coastline Capital Fund 2. The return to the investor on that was 9.7%, which we were really disappointed with because it should have been more about 17%. We had one outlier that we ended up taking a loss on, unfortunately, but the other four were fantastic winners. And that's another advantage of investing in a pool and investing in multiple notes, is that your winners can make up for your occasional note that might not do so well. But the other funds have not fully liquidated, and we have I do publish quarterly reports that show how each of the notes does. So the future will tell how those note funds will do.
Yeah, and then I mean you could go into what happened to kind of explain that loss. What happened was we actually had 1 in 1,000 chances of this hurricane coming through the property. It veered the wrong direction, came directly for our property. We were 4 miles in from the coast. Everything was kosher, and then it ended up getting flooded. So that's where the loss came in. Rather than put more money into it, we had to just cut ties with it and move on. But yeah, it was disappointing, but at the same time, Andy had a great point. The other assets performed very well. Again, the more we can buy, guys, the better this investment is. The waterfall effect really takes control and spreads the risk around to where, you know, even if you have a break even or a loser and you have multiple gains in other aspects of or other properties, you can compensate and use that waterfall effect to balance out the portfolio. This one here I really like by Chuck. This was pretty cool. He liked this better than the other note funds he's seen due to the fact that we share in the upside. Well, you know, we like building the relationships with our investors. The investors that we have now are basically in every fund that we've done. So we're doing something right on that end. Whether we're fun to work with, I don't know, or we're just funny and make people laugh. But at the end of the day, we get the job done, and that's one thing we do try on. He asked, what happens if both of us get hit by a bus? Well, hopefully that doesn't happen. And you know, at that point, if everything were to collapse, the LLC that all the properties in would go back to the investors, and the investors would, at that point, and correct me if I'm wrong, Andy, would take over the portfolio at that point. And also, I don't want to get into too much, but my wife actually is in the space too, so she'd be willing to, you know, execute with the fund to help us get us to fruition to get everybody's money back and things of that nature. So hopefully that, I hope answered your questions.
Yeah, Sean, let me jump in just for a
Sure.
second on that. So yes, our operating agreement does have provisions for the preferred members to take over into that. But we want to do even better than that. So Sean and I are in the process of identifying people in our industry that that might be able to take over management. So it would be an easier transition. So that's something that we still have to figure that out. But we do want to have a succession plan, so it's not just the preferred members,
And the good part, guys, just so you know too, that Andy and I will never be on the same plane at the same time. So that's a good thing, and we shouldn't be walking at the same time. We're a little bit far apart now, so hopefully nothing like that happens. Yeah, but that's a great question. Let's see. Can I invest as an LLC? You absolutely. You can also. We have people that do it from their IRAs and things of that nature. Andy typically handles that part of it. So if you want to elaborate on what they can do and how they can invest, by all means, jump in.
So a short answer for the LLC is that to qualify as an accredited investor, all of the members of the LLC need to be accredited investors. So as long as that's the case, then we're good.
Yeah, and then Chuck also had a good question. If they signed a subscription agreement prior to 12/15, will they receive a K-1 for 2020?
That's a question for our CPA. I'm going to have to talk to him about that.
We can get back to you, Chuck, on that. If you want to drop your email, or if we have, I'm sure we have his information. We could get back to you on that. We don't want to give professional advice on that until we know for certain from our accountant.
Right. Yeah. So I'm not sure if we can just roll over the month of December into 2021 or not. But even if we can't, the K-1 wouldn't show any income. So, but that's something that we'll answer. We'll get the answer to that right away.
Perfect. Alec, to answer your question, this is what we do. We do this full time. Do we run other business concurrently? I actually own a few other businesses, but I do not manage those as I manage this for the non-performing notes. It was going to be a question that I was going to actually put out there right now, so I'll go ahead and do that. So one of the questions I want to, if I was an investor, I'd want to know. So this one would be, how do you liquidate your REOs? Well, just to give you guys a background, Coastline Capital, we also have a Coastline Capital Asset Management. And Coastline Capital Asset Management is ran by Vicki Irwin, which has been doing this quite a long time. She manages for other funds, very, very large hedge funds out of New York, the REOs throughout the country. Yeah, she also manages Coastline Capital Fund's REOs as well. So I do get involved on the REO side with the fund REOs to make sure we're doing exactly what we need to do to maximize our profits. So we actually go into, breaking it down to where, if you guys are familiar with the pyramid platform, we use that to manage the agents across the country. She manages anywhere from 70 to 100 assets at any given time. She does a very, very good job. There's a lot of, if you guys were able to talk to the investors that she manages, they would give her big kudos on her performances, as she's actually #1, and she's outperformed major servicers. I don't want to drop names, but she's beaten a lot of major players out there in returns for the investor, which is great. Plus, I get a discount, guys, because I know the owner. So that actually gets passed on to the fund as well, which is pretty awesome. But again, yes, I do get involved heavily on the REOs, especially when it comes to rehabs, because a lot of times, guys, when we foreclose on these, we do get them back as REOs, and we want to make sure we look at every asset from what is it going to take to get it to the value that we want, how much do we have to put in, how much time is it going to take to do it, and are we going to get a 20% on the money, the invested money, to rehab it on top of that. So we look at the whole spectrum from start to finish, which is very profitable for the investors. Or we look at it and say, hey guys, we'll take a smaller return. We don't have to put up the risk, and we'll make the right decisions to go ahead and sell it, and it's still as a profitable return for the fund. So that, hopefully that answers your question, Alec. Another question that we get a lot is, who's our servicer? Our servicer is FCI. I'm sure if you guys are in this space or know a little bit about the space, I'm sure you know who they are. We've had a good partnership with them. they understand how we operate. And Andy, I think, said it best in the webinar, where we don't tolerate delays, and we're not mean, but we're very adamant about them performing at the level that we perform on getting things completed. That it's that way with our attorneys, it's that way with our vendors, from BPOs to title to whatever it is. We're very persistent on pushing them to provide, because to us this is time over money investment. We need to perform quickly and get to liquidations to provide the best returns that we can. Is there any other questions that you guys have that we'd like to answer? I'd love to answer them. I'm here. You guys could, always reach out to us via email, phone calls. We definitely interact with the investors. And this must say a good thing about us, because not a lot of investors call us that's invested with us. They know the performance that they're going to get from us. So again, if you want to say hi, Merry Christmas, Happy Thanksgiving, we'll do the same. We like that. We're looking to build relationships. This is not about, okay, how much money can we make? It's about what can we do over the course of time with the people that believe in us. So I'm not sure, again, if any of you guys have any other questions. I'll give a couple seconds here to see. But otherwise, I could go all day talking about this business, because I do love it, and I know Andy truly loves it as well. Yeah, so okay.
Yeah, Sean, I just wanted to add to Alex's question about other businesses. So I have some rentals with a partner of mine. Luckily, he does most of the day-to-day management of it, so I only have to do a little bit of it. But yeah, for both of us doing the no business that we're doing right now, this is our full-time job. This is what we're doing for a living.
Okay. All right. Let's see. Somebody throw a question at me. Come on. I'm ready. Come on. Let's go. And keep in mind, guys, we like to have fun as we do this too, because this business can be very stressful, and you're dealing with real people. So we do make the best of it, and like I said, I believe we make the right decisions based on the information and how the borrower is behaving to do the right thing to get this liquidated, the assets liquidated. So okay, well, Andy, I don't think any more questions here. I don't see any more questions, so. I'll put it back in your court, Andy.
Okay, so thank you very much for joining us on the presentation and the questions and answers. If you didn't get your question, if you think of more questions to ask in the future, just shoot it over by email or give us a call, and we'll be happy to answer it. All right, thank you for your time, and enjoy the rest of your day.
Go check out the website, guys. Enjoy. Happy holidays. Take care. Bye-bye.